one thing we've been discussing a lot on this program is this notion that the IPO market is dying. And there's obviously the fact that actual deal activity has come way down. It's picked up a tiny bit this quarter. We saw IPOs from Arm and Klaviyo, Instacart, Birkenstock. But those deals haven't really thawed the IPO market in the way that I think people expected. And in addition, they're all trading down from their issuance price. But the thing that we've been more focused on this program is the quality of the companies going public. So there's just this one stat that I'd love to get your reaction to. In 1980, 78% of VC-backed IPOs were profitable when they went public. In 2021, that number was 10%, and last year it was 0. So would you consider it a fair statement to say that the IPO has transformed from a financing instrument for companies to build their businesses to a liquidity instrument for existing private investors to cash out and, for lack of a better term, dump the bag?
Actually, there's an internal contradiction in the way you set it up, because if you're a money-making company, you need access to capital less. In the 1980s, by the time Apple and Microsoft went public, the need for capital had shrunk because they had an established business model, but they were willing to be patient. What we've had in the last 10 or 20 years in particular is an emphasis on scaling up and essentially putting business models in the back seat. Do you know that the typical IPO now, in terms of revenues, is 5 times larger than the IPOs in the 1980s? So it's a very strange phenomenon. The companies going public actually are much bigger than the companies that went public 50 years ago, but they're also less formed in terms of the business models. And I think this started a while back. It started with the dot-com boom in the 90s, and essentially it reflected a shift in perception that, until the 1990s, the perception was you had to be established as a company in terms of business models before you went public. The 1990s, companies started to jump that step, go directly to the market, even though their business models had not been formed. So part of that is just that shift. But I think one reason bigger companies with less formed business models are more likely to hit the market is because of the way VCs are rewarded in the VC market. VCs are being rewarded for scaling up much more than building business models. So they're going to do what they're incentivized to do, which is scale up, get more users, get more subscribers. Don't worry about making money yet. That can be down the road. And that can be a very dangerous process for both businesses and the overall economy.
Just an example, let's talk about Instacart, which you recently valued at $29 per share before the IPO. And that was roughly equal to its offering price of $30. It got a pop on its first day of trading, but it's now down to around $25 per share. And it feels like this is a theme with a lot of these companies with probably big revenue, but maybe their business models are less built out. One, do you think that Instacart is a sustainable business that can grow? And two, do you think that the market is undervaluing Instacart at this point?
I think of 3 high-profile IPOs. You got Instacart, you got Arm, and you got Birkenstock. 2 of those 3 companies have business models. They're making money. Arm and Birkenstock actually are more established. Instacart is a strange beast. It's a COVID phenomenon. It's a company that in 2019 was expected to be a niche company that somehow during COVID people decided could become a company for everybody. So I think what you're seeing with Instacart is still a working through of what exactly online grocery shopping is going to look like. Because unlike the rest of retail, grocery retail has been impervious for the most part to online shopping for good reasons, right? Which is if you're going to buy produce, you want to see your produce before you get it rather than have an Instacart shopper do it for you. The difference between 25 and 29 is not a huge difference. Markets are still trying to figure out what the company is worth. And it was actually valued, I think, relatively conservatively. And that's the other thing to factor in. 2 years ago, Instacart had gone public in 2021, which is a peak year for IPOs. Assuming the number of the share count had stayed the same, they'd have been priced at $60. They'd have opened at $80 and gone up to $100. What's changed is the market has shifted between then and now, and you're seeing that play out with each of these IPOs. Now, I call this risk capital. Risk capital is always a part of every market. And risk capital went to the sidelines in the middle of last year. It stayed on the sidelines since. It's not come back. Even if the market's been a little healthier this year, risk capital has not come back. And I think these IPOs are suffering because of that phenomenon.